Across this series, we have looked at 5 topics: what actually moves price, gold versus stocks, crypto versus equities, how CPI and inflation data transmits across markets, and why the dollar sits at the center of everything. Each one from its own angle, each one with its own set of drivers. But if there is one thing these videos have been building towards, it is this: none of these markets operate in isolation. They are all expressions of the same underlying forces. And once you see the framework that connects them, reading any chart you trade gets significantly clearer. So this is that video, the big picture. Before we get into it, if you're looking to start your investing journey in the UK with a head start, check the link down in the description for the best platform sign-up deals, including up to £500 in free shares. This is not financial advice and your capital is at risk. The framework starts with one question: is liquidity expanding or contracting? Liquidity, the amount of money and credit available to flow through financial markets, is the master variable that underlies almost everything else. When liquidity is abundant, borrowing is cheap. Capital has to find somewhere to go, and risk assets across the board tend to benefit. When liquidity tightens, the capital pulls back, the cost of borrowing rises, and assets that depend on speculative demand tend to fall first and hardest. The primary control lever for global liquidity is interest rates, set by central banks, most importantly, the US Federal Reserve. When the Fed cuts rates and expands its balance sheet, as it did aggressively in response to the 2008 financial crisis and again in March 2020 during the pandemic, it injects liquidity into the system. Money becomes cheap. Investors move up the risk curve looking for returns. Stocks rise, gold rises. Crypto, once it became a mainstream asset class from 2020 onwards, rose. Commodity currencies strengthened. Almost everything went up together because the underlying tide, liquidity, was rising. When the Fed tightens, as it did between 2022 and 23, with one of the most aggressive rate hiking cycles in decades, that tide goes out. The S&P 500 fell approximately 19% in 2022. Bitcoin fell approximately 65%. Real estate, growth stocks, speculative assets of all kinds contracted sharply. Not because anything changed specifically within each of those markets, because the macro environment that had been supporting all of them was withdrawn simultaneously. Now layering what we covered about CPI, inflation data is the primary signal that tells central banks how to position that lever. A hot CPI print tells the Fed that inflation is running above target, which typically leads to higher rates, tighter liquidity, and pressure across risk assets. A cooling CPI print opens the door to rate cuts, which loosens liquidity and tends to support risk assets. This is why a single data release at 8:30 in the morning can move stocks, gold, crypto, and Forex simultaneously. It is not because they are all watching the same number, it's because they are all sensitive to the same downstream consequence: what the Fed is likely to do next, and what that means for the cost and availability of money. Now bring in the dollar, as we covered in episode 5. The US dollar sits at the center of the global financial system, involved in approximately 88% of all foreign exchange transactions. When liquidity tightens and rates rise, the dollar tends to strengthen because higher US rates attract global capital seeking yield in dollar-denominated assets. A strong dollar then ripples outward. It suppresses gold, which is priced in dollars and becomes more expensive for foreign buyers. It pressures commodity currencies like the Australian and Canadian dollars. It weighs on crypto, which competes with dollar-denominated assets for speculative capital. One macro force, 4 simultaneous effects in 4 separate markets. When liquidity eases and the dollar weakens, the transmission goes in reverse. Gold tends to benefit. Commodity currencies tend to strengthen. Risk assets, including equities and crypto, tend to rise. The whole system breathes in and out together. And sitting across all of this is gold, the asset that has historically served as the barometer for how much confidence investors have in the broader system. When the framework is functioning, growth is stable, inflation is contained, rates are predictable. Gold tends to be quiet. When something in the framework breaks, or when confidence in it erodes through a crisis, a geopolitical shock, or the prospect of persistent monetary debasement, gold tends to move. Not because of any one of those factors in isolation, because it responds to the aggregate level of uncertainty in the system as a whole. What makes this particularly striking right now is that gold has done exactly what that framework would predict. Over the last 12 months, gold is up approximately 70%, its best run in over 4 decades, driven not by any single event, but by the accumulation of uncertainty the system has been absorbing. Trade wars, geopolitical instability, dollar weakness, and growing questions about the long-term trajectory of US fiscal policy. When all of those things arrive at once, gold doesn't just move, it moves significantly. So what does this mean practically when you open TradingView? It means that before you look at the chart of whatever you trade, the most useful question is not what is this asset doing, it is where are we in the liquidity cycle? And what is the macro environment signaling right now? Are interest rates rising or falling? Is CPI surprising to the upside or cooling? Is the dollar strengthening or weakening? Is capital flowing towards risk assets or away from them? The answers to those questions do not tell you exactly what price will do. Nothing does that with certainty, but they tell you the conditions in which you are operating. And that context, the macro environment behind the chart, is what separates traders who understand what they are looking at from those who are only seeing lines on a screen. That is what this series has been about. Not telling you what to trade or when to trade it, but giving you the foundational layer of understanding that makes everything else, every chart, every strategy, every price movement make more sense. If this series has been useful, subscribe to the channel. There is a lot more to come. If you found today's episode useful, subscribing genuinely helps us keep making these videos. This information is not financial advice and is for educational purposes only. Always do your own research. Your capital is at risk.